Welcome to the Real Estate Investor Podcast. I'm your host, Gary Lipsky of Break of Day Capital. I talk to leading experts to discuss a wide range of subjects to educate investors on best-in-class practices to build legacy wealth and positively impact communities. Let's jump in. Today's podcast is a town hall I recorded with Dr. Peter Linneman. As always, Peter provided incredible insights on interest rates, inflation, where the best opportunities are to invest right now, and his number one piece of advice for investors. I know you're going to get a ton of value from it. Enjoy. If you've been listening to this show for a while, you know we focus on going a mile deep instead of a mile wide. That's exactly why we're buying again in Tucson, our 12th deal in the market. Our latest acquisition, Icon on Broadway, is a 300-unit multifamily community purchased well below replacement cost with day one cash flow and conservative underwriting. We're projecting a 16 to 18% IRR with significant bonus depreciation in year one. If you're an accredited investor and want to learn more, you can access the deal room at breakofdaycapital.com.
Financial advisor Bromley Palamountain of Northwestern Mutual empowers people to make their financial dreams a reality through purpose, clarity, and design. Be sure to check out his links in the show notes.
Welcome, everyone. Thanks for joining us today. I'm honored to have Dr. Peter Linneman join us. This is his fourth year in a row joining us. Peter is the founding principal of Linneman Associates, LLC, a leading real estate advisory firm and its affiliates. For more than 40 years, he has advised leading corporations and served on over 20 public and private boards. He has published over 100 scholarly articles, 8 editions of the acclaimed book, Real Estate Finance and Investments, Risks and Opportunities, and the widely read Linneman Letter quarterly report. He's also the co-creator of the popular and highly regarded Real Estate Finance and Investment Certification course, REFAI. And he's also co-authored the best-selling book, The Great Age Reboot, Cracking the Longevity Code for a Younger Tomorrow. Thanks for joining us, Peter.
My pleasure. Thanks for having me back.
Yep. So the economy has been more resilient than many expected. What are investors still getting wrong about where we are in the economic cycle?
So, as you know, you've spoken with me and you follow me. I said a year ago, we're not going to have a recession in the near term. And if people who follow me and Linneman Letter or whatever, we're not going to have a recession. Try as we might, we're not going to have a recession. And the geopolitical events are not helpful, but they're never as bad for us. They can be very bad for other places, right? But they're not as bad for us, people think. And what I've never quite said this simply before. If you go back to the days when China was Red China and we didn't deal with them at all, right? Zero. You go back to when Nixon and they go play ping pong. That was the importance of China, was this ping pong. You go back to the Soviet Union prior to 1989. We had no dealings economically with them at all. And South America wasn't much of an economic force. And you say, well, how did the U.S. do well, quote, all those years after World War II? And the answer was largely us, right? And yes, of course, we benefited from Europe. And of course, we benefited from South America. Of course, we benefited. And what people miss is that if we don't misinterpret, we should deal with others. But if we never dealt with others, this is one powerful economic beast that can do a lot. We have human capital. We have a fairly decent government structure certainly by historic standards of the world. Is it surprising that a country that is large, a single language, basically a business, a single language, relatively secure, etc. Is it a surprise that it does well almost all the time? No, it's not. When you throw in, oh yeah, and by the way, we can pick up some trade business over there. That's good. Some trade business over there. Some pickup, some arbitrage in producing more cheaply there. Of course, right? But this is a powerful, powerful beast in and of itself. That's what people miss. They really miss what we're up to 340 million people that have a decent degree of political and judicial and financial certainty. And so, for example, and these are quick numbers, Germany's GDP per capita is basically the same today as a decade ago. UK's is essentially the same as it was today as it was just before the financial crisis, which is almost 20 years ago. It's like 18 years ago, right? So obviously we can do well when they don't do much, right? Would we do better if they were doing really well? Of course, right? That's what people miss. And I'll give a very simple example in the energy context. The US, if you go back in history, was a dominant oil producer. Back in history, John David Rockefeller kind of back in history. There comes a time in the early 1970s, we're a big importer of oil. We get this huge shock that happened from the Middle East in the 70s. We then adjust, we become much more energy efficient, blah, 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 blah. And ultimately, we start doing much more offshore drilling, deep water drilling, cold weather drilling, using the technology that we have and improving. And we get fracking. And we get fracking to a huge scale so that by 2014, the fracking revolution, 2012, it's happened in natural gas, by 2014. Is it surprising that a country that's creative and this and that and a fair amount of freedom goes from being a big importer to a big exporter? We're the largest exporter of oil in the world, largest exporter of natural gas in the world. We are a net exporter of both. And meanwhile, Europe, and this is not beat up on Europe, Europe has shale formations as well. Europe has a lot of shale formations, but they don't drill. They refuse to drill. And in fact, they're scaling back drilling in the North Sea, right? And they've kind of outsourced their pollution, if you will, right? Under the image of, well, if we don't do it, but we import it from, right? So of course, we are a powerful beast. And we will chuckle. Will we have a downturn? Yeah, I still think we're 2 or 3 years off. You say, what about the energy situation? The United States, bizarrely, what are the 2 biggest geopolitical events of the last 4 years or 4.5 years? Russia invading the Ukraine. And you may remember back when we first talked about that, I said the US is a net beneficiary because of agriculture, because of energy, and because of military, right? And we've been a net beneficiary of it, economic beneficiary of it. Not huge, but net. Okay, you're the largest exporter of oil in the world. You produce 21 to 22% of all oil that's produced in the world. The next largest producer is Saudi Arabia at 11%. Oil prices go up, and everybody else who's not everybody, lots of your competitors can't get it out. Do you think we benefit? Yeah. So think of it this way. And this is overly simplistic. Just think of it, the US as a whole. Don't think of you, don't think of me. We're a net exporter. That way to think about that is we provide all of the oil and gas for US consumers by what we produce. That means when you pay more at the pump, I receive more from you as a domestic producer. And those cancel one another out. It's just whose pocket is it in? Fair enough?
Yep.
And on top of that, we have these foreign pockets that we're getting paid more by. Okay. So if you just think of it really simple, we net win. From this current geopolitical event, we actually are a modest net winner. Not you necessarily, not a lot of the people, because they may not own the oil companies and the natural gas companies. But if you just do the math of it, we win. And you go, oh, yeah, that's why we're doing, quote, okay. Now, the problem is probably, what would you guess? 85-90% of the people are losers and 15% are winners. So, for example, I don't own a car. I don't drive much. I walk most everywhere. I live in the urban area, blah, 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 blah. And through my various investments, I own shares in the oil companies and the natural gas companies. I've never done this math. My guess is I've won more than I've lost. On the other hand, if you drive 32 miles to work every day and 32 miles back every day, and you don't have a portfolio of oil and gas, you lost, right? And so I don't know. I think that's what people miss to answer. That's a long way of saying they miss everything.
Right. Well, in there, you also mentioned the 2 to 3 years away of a recession, or what is that looks like, and is that driven by AI, or what is it driven by?
Well, historically, recessions occur regularly but irregularly. In other words, it's not like clockwork, but they occur all the way back through the history of the country. Okay. And so recessions occur. They generally occur every 6 to 10 years. They generally occur when times are too good and you overdo. And then the bill comes due. And so I'll give you the classic one. It's not all of them. Gee, everybody feels good. They all run out and buy cars. Everybody buys a car. And they buy all the cars they need for this year and next year, this year. Great while you're doing it. Lots of jobs, lots of money out there while you're producing it. But then next year, who needs a car? And the housing has been that way historically, right? We build all the housing we need for this year and next year, and we do it this year, and this year's terrific. But then next year comes and nobody needs a home and you get shut down. Okay. And you can get other examples, but those are the classic kinds of stuff. You need excess. There's no excess in single family housing. Single family, way underproduced. Okay. Multifamily, by historic standards, yep, there's a lot of supply, but this is not like the late 80s, early 90s, where you just had staggering amounts of supply. Apartment markets were 15% vacant. You don't have that now. You have pain, but you don't have that. Auto massively overproduced since the beginning of the pandemic. At first, we wouldn't go out and buy them. We couldn't go out and buy them. Then we wouldn't go out and buy them. Then just as we were willing, they couldn't get the parts. Then just as that happens, oil prices went up and so we have a shortage of auto. So we don't have excesses there. If I said, where's there an excess? AI related investment. You could argue that we're doing all the investment in AI we need for the next 3 years, this year, last year. But that excess isn't going to show for another year or two. Okay. And maybe it's not an excess. Maybe it is a real breakthrough, right? But that's the only real excess I see. People say, well, what about government spending? We always have excessive government spending, right? It's not new. You say, well, the deficit's bigger. Yeah, but we're wealthier, so we can afford a bigger deficit. Just think of the deficit as a debit on the balance sheet of households. Okay? Because at the end of the day, that's a liability of the households, right? So is it surprising that if 3 years ago we probably had 140 trillion in household wealth, and today we have 180 trillion in household wealth, okay? And against that is the deficit that accumulates. If you have 40 trillion more in wealth, not counting the federal debt levels, would you be shocked that you had, I don't know, 6 trillion more in debt? If you've got 40 trillion more in assets, would you be shocked if you have 6 trillion more in debt? I mean, that's not shocking. It's not frightening. People say, well, how long can you run the deficit? The answer is forever. If you're rich and your wealth is growing, you can run an income deficit forever. How long? What's Elon Musk supposed to be worth?
Well, after SpaceX,
pick a number. Pick a number. Let's say it's 600 billion. Okay.
Yeah, okay.
Let's just take that number. How long could Elon Musk run a $10 billion cash flow personal deficit? Okay. He's spending, not investing, he's spending 10 billion more than his income. So he has income, he's spending 10 billion more of it, not including investments. How long could he do that if he's worth 600? And the answer is long damn time, 60 years, right? Oh, and then you'd say, oh, but the assets are earning. So if it's 60 years, he could do that without the assets earning. How long is it if the assets are earning? And you go, oh, I don't know. Imagine if the assets are earning 11 billion a year and he's over only spending by 10. So the corpus is growing every year. That's us. We're really rich and we really grow. That's not most of history and it's not most countries, but we can do it. That's not an excess. It may be stupid. That's a separate question, but it's not an excess.
So then my next question would be, okay, obviously the deficit grows and grows and grows, and let's talk politics for a sec. You've got, Warsh is in. You hear different things of where the Fed rate is going to be. What's your opinion on this?
Okay, so this one is pretty simple. Shockingly so. If you look at the 30 years prior to the pandemic, and we know the pandemic totally took the cards and threw them in all directions, and it took a couple of years to put the deck back together, okay? So I only take the 30 years prior to the pandemic in the sense it's a long time, and the annual average rate of inflation over that time period, if you excluded owner equivalent rent, which no one pays, that's the rent you supposedly pay to yourself. You never pay it and you never receive it. And yet it's a huge part of the price index. If you take that out and only look at the things that people actually pay for, 2.2% for the 30 years prior to the pandemic. And if you do the same calculation, but stop just before the bombings occur, okay, it's 2.3%. Now, that's a way of saying is prior to the pandemic was normal at around 2.2, and then we had gotten back for 2 years to 2.3%, and I can't tell 2.3 from 2.2. Right. I was educated in Catholic school. They both look very similar, okay? Now I said, but what happened since? So you'd say, okay, if I ignore what's happened since, the interest rate's way too high. The interest rate should come down if inflation for things people pay for is 2.3%, add 50 basis points, add 60 basis points, that's 2.8, 2.9, and the rate is between 3.5 and 3.75. So it should come down, right? You say, but now we just had today another inflation number come out that's big, but it's all from oil. If you strip oil out and you strip oil and owner equivalent out, guess what the inflation rate is? And the answer is about 2.3%. So it says everything that people are buying except one thing, oil and gas, but oil is under control. It's one item. What should the Fed do about that inflation? If the Fed raising interest rates or cutting interest rates or doing a dance on the Washington Mall were to open the Strait of Hormuz and settle the conflict, they should do it. But the Fed doing a jig is not going to open the strait or settle the Middle East. The Fed cutting the interest rate isn't going to settle things in the Middle East or open the strait. The Fed raising the interest rate isn't going to do it. All it's going to do is make it seem like you're doing something you have the power to do, but you don't. That's a Wizard of Oz world where there's somebody behind the curtain doing shit that doesn't do anything and has the risk of harming things. If you believe you can control things when you don't, you have a serious chance of doing harm. So what I'm afraid the Fed will do is say, oh, gee, inflation's up. We have to raise interest rates. But the inflation's not up for any reason they control. It's controlled with the negotiations about the strait and about what's going to happen there. Has nothing to do with the Fed.
Yeah. Let's go to the job report. The jobs report. How did we get such a positive jobs report? Because who out there is hiring? And I know they adjust down every time, but boy, that threw a loop too.
Okay. So let's just talk about it fundamentally for a moment for your listeners. I'm doing this off the top of my head. They being Bureau of Labor Statistics, surveys, I think, 121,000 establishments. So a business can be an establishment, a church could be an establishment, a hospital could be an establishment, a city government could be an establishment, certainly the federal government is an establishment, et cetera. So they survey 121,000. They give them essentially 2.5 months to respond. Okay. When you see the first numbers, it's from those who have responded by the end, by a sense, I think the end of the first week of the month after when they report the data. Okay. The revisions are, oh, gee, some more of those came in. It's like they're counting votes in California, right? They are already in the mail. They were already done. And if you, and generally they don't have a lot more come in. But when you hear about revisions that are occurring, like the first revision and the second revision, those revisions are only reflecting extra data that came in from the original survey, like late responders. Okay. So that's important to understand, and they could go either way. All right. Now, that's not the puzzle. The puzzle is last year. This year, I don't find surprising. This year, I think it's running about 100,000 jobs a month through the first 5 months of the year. Average, right? Hotter 1 month, colder 1 month. And so. And if I told you 100,000 or 105,000 a month times 12 months, 1,000,002 jobs, let's say 1,000,000 to 1,000,004, you'd say, it's not red hot, but yeah, I can believe that. Some sectors doing a lot, some sectors not doing a lot. Okay. It was last year was the puzzle. And last year, the answer was about 180,000. Now we have 160 million jobs. You lived last year. Do you think there were only 180,000 jobs added on a 160 million job economy? I don't. I just knew too many. I almost knew. I knew people who hired 180,000, right?
Wow.
I don't think it was a spectacular year. If you kind of triangulate and you say, well, look at retail sales. Well, look at the stock market. Well, look at home prices. Well, look at travel and leisure. Well, look at, if you look at things, it wasn't people filing for their unemployment. It wasn't 180,000 kind of pace. That's basically recessionary. And we did not have a recessionary feel last year. We had a slow feel. I come out guesstimating we had about 800,000 total last year, okay? Not 180. Can I prove it? No, only in the triangulation way of other indicators, okay? Would 800,000 be a great number? No, it'd be a quite slow number. If I told you last year was 800,000 and this year's on the pace to be 1 million to 1.4 million, I think you'd say that kind of feels right in that things are a little better. The tariff craziness seems to be over. Yes, the Middle East, but I told you we net are benefiting from that. As crazy as that is, we're net benefiting from that. Feels kind of, we should be doing better than last year. And last year, I think, was 800,000. How did they get to 180? I can't tell you, but I can give you an idea. They're sending out to 121,000 firms. Every year, every month, the response rate is going down, just going down. It doesn't matter who's in office. It's not unique to them. Response rates to all surveys have fallen dramatically over the last 20 years and continue to fall. When's the last time you answered a phone call from a number you don't know who it is? That could have been the BLS calling you, asking you a question, right? Last year, late, one thing happened. The decline appeared to go even more so declining, particularly among small firms. Okay? Now, remember, imagine you're a statistician and you see more non-responses. Is that because of this trend? Or is that because a whole bunch of businesses went out of business? To the extent you have an algorithm that says it's because they went out of business, but really they're not responding, you didn't add enough jobs, right? You just didn't add enough jobs. I think last year, and I can't prove this, I cannot prove this. I do know the response rate went down. I know it went down particularly in the second half of the year, particularly among small firms. Now imagine you have 22 employees, 14 of whom are illegal immigrants, and you get a survey from the government that says, tell me about your employees. And there's no reward for answering it, and there's no penalty for not answering it. What are you going to do?
Yeah,
answer. You're not going to answer. And therefore, I think statistically, they basically were applying the traditional algorithm, okay, if you will, of how to adjust for the declining rate, but it was declining faster. And because of the whole ICE stuff, you just had a lot not responding, and they counted them as out of business. The ICE stuff it's still going on, but you're in the same world I am. Is it as big a deal as it was at the end of last year? No, not remotely. Are there still firms saying, I got 14 illegals, I'm not answering? I'm absolutely sure. Of course, right? You're probably closer to normal that way. And that's why the job numbers start looking more normal. And you throw into that, the tariff stuff seems to be behind us. So I know that's a long answer, but as you know, that's the only kind I give.
So, my crystal ball broke a while ago. I'm not sure about yours, but we touched on it briefly. But where, what you think should happen and what the reality will happen. Where do you think interest rates are in a year from now or 2 years from now? Like where is it?
Okay. I'm very hopeful. I don't know Warsh, just so people know. I don't know Warsh. As you know, as long ago as 2 years ago, well before Trump was saying it, I was saying we have to cut interest rates. Right. They did, but belatedly and not enough. I still remember what goes up, oil prices do come down. And all you have to do is look at a chart of oil prices over history, and yep, they go up. And when they do, they're inflationary, but when they come down, they're deflationary, right? And I think yet this year, oil prices are going to come down. I have no idea when. Oil prices are going to come down, and you're going to see measured inflation go from 3.8 to 1.4%, all because of oil, with everything else being like 2.3, right? 2.4. And all the swing up will be undone in a swing down. Right. That will make the Fed worry about deflation, which they are terribly worried about all the time. That will cause them to cut rates. They're going to get mediocre job numbers. They're not going to get great numbers or bad numbers. They're going to get mediocre job numbers. They're going to look at the interest rate at, let's just call it's between 3.5 and 3.75. So let's call it 3.6, just for a number. And they're going to say, gee, measured inflation now is run 1.4% as oil prices come back to $70 a barrel or something like that. And they're going to say, oh, we don't want to have a dead economy on that, and so forth and so on. By the way, the economy will be cooler because we benefit from higher oil prices. In the same way, we're winning now. We are going to lose when the oil price goes down, right? Even though most consumers are going to win. So it's the exact flip. And I think they're then going to cut the interest rate. I still think, I said 75 basis points cut this year. The oil situation complicates it. I still think if I had to pick a number, I'll take 75 basis points still this year, only on fundamentals, that the fundamental rate is too high relative to the fundamental inflation rate, even though the instantaneously measured rate of inflation is higher, but it's going to get offset by a negative when the oil price goes the other way. That's what they should do. No man's safe while the Fed's in session, and I don't think they do anything with their next two decisions, and they'll sit out August. They don't meet in August except for emergency. I think they meet next week, and they meet in July, and I suspect they'll do nothing. There'll be a lot of hemming and hawing. I suspect Warsh and a couple of the others will keep it from being increased, but not get it to be decreased, even though there'll be several. And if I were on the Fed, I'd be doing it not because Trump's saying it, but because it makes economic sense. Trump can't fire me, And I just think it should be down, but I think they're going to sit neutral. They're going to fight with one another and sit neutral this month. They're going to fight with one another, sit neutral next month. They get August. They don't have to fight with one another to sit neutral. And they're going to come back in September, and you're going to see where oil prices are at that point and make a decision. And I think, look, they've already fallen from 110 to 92. That'll show up in next month's inflation data as less inflation. Yes, the price is still high, but it'll be the decline from 110 to 92 that'll be showing up.
Yeah. And the poly markets, I think, predict by September they down sub 70, but we'll see how that goes.
They're betting that the Fed raises rates.
Right.
That's all that bet is.
Yeah.
And you think about it, the long bond is a substitute for the short bond. If you think they're going to raise it, you got to compete against it. And I've gotten the Fed right for 2 years, and I got them right mid-year both times when nobody believed me. And I'm not going to always be right, but I think I've got a better chance of being right that they'll reduce by 75. They could even raise 25, but then that just means they're going to unwind more so.
We've got a lot of real estate investors on this. Multifamily seen probably a 35% pullback in the last few years, highest cap rates we've seen. Office has come back to life, but there's still a lot of nervousness about AI. How does that affect office space going forward? Curious your thoughts on commercial real estate.
So office is, I said 2 years ago it had hit bottom. And basically I got it right. But I didn't think it would be a fast recovery, and it hasn't been. AI absorption is helping. It's not helping in every market, but it is helping in some markets. And office is getting stronger on law firms and traditional tenants as it goes. And capital is returned to office, not bucket loads, but we went from 2 years ago, there was no money available, none, right? And today, if you wanted to sell a building, there's money out there. There'll be a bid, there'll be a number of bids. You'll call Eastil, they'll run and so forth. So that's a big improvement. I think transaction volumes in office are still only about 50% of normal. So it's still got a way to go. So rent and occupancy improving and capital flows are improving from non-existent to bad. But bad feels good after non-existent, okay? If you go to multi is not been a demand problem. If you think of rent and occupancy, it's all been a supply problem. My friend Sam Zell always said that supply is the enemy, and everybody thinks that demand is the only thing you need to look at. And one of the fundamental insights of economics is supply and demand matter. And we do a generally better job of forecasting demand than supply. It is, if you go to Austin, just take the poster child, right? Demand's been okay. If all you saw was absorption, you don't see negative absorption in Austin. There's not like, or in Nashville or in Raleigh, you don't have negative absorption. You still have pretty good absorption. I'm not saying the best ever, but you have absorption. Phoenix, you have absorption. What you have was staggering too much supply all came at once. And that meant people had to do concessions. By the way, if you'd have spread that out over 3 years, it'd been fine. But a whole lot of it came in 3 months. And a lot of reasons for that. So what it did was create weak rent and occupancy. And that has created kind of there is plenty of debt available for multifamily. That wasn't true 2 years ago. Today, I think you'd agree, there's debt available for multifamily if you can get the equity. right? If you walk in and say, I need on a decent cash flow, I need a 60% loan, you go get Fannie or you go get a bank 3-year, 7-year, you can find 60% debt. The question is, where do you find 40% equity,
Yep.
right? So the debt has come back and the equity hasn't fully come back. So transaction volumes have risen from about half of normal 2 years ago to about normal today. But it's largely being driven on the debt side, not crazy debt, right? Just kind of normal debt. And you need equity to come off the sideline. The problem is, I was just on a call this morning. The problem is so many of the capital sources got hammered on the last 3 years of performance that they don't want more multifamily. I think it's a big mistake. I think it's a great sector long term. I don't know if it's a great sector if I was going to hold for 6 months or a year, but if you're going to hold for 5 years, 7 years, all the research I've done says you're going to do fine. Supply shuts down. So I think market rate supply nationally is about half of what it was 2 years ago. Okay. That's going to get things healthy. By the way, back to office. I think I saw a JLL or a Cushman and Wakefield study of 3-4 months ago that said in a normal year, 50 to 60 million square feet of office are built in a typical year. That feels about right, 50 to 60 million nationally. 9 million in 26 and 27 combined. Okay, what's a good way for office to get healthy? Build 9 million instead of 100 million and have any demand at all. How's multi going to get healthy? Multi's going to get healthy because you are still going to have demand. People have jobs, they're getting raises. Everybody wants more job opportunities. Everybody wants bigger raises, but they're getting raises. All you have to do is look at the data. They're getting jobs, as you were pointing out, and no new supply. And in 2 years, things are going to look a lot healthier. I think it takes that healthier to get the equity off the sidelines, because a lot of the sidelines money is saying, I'll go check out AI while I'm at it, or I'll do data centers while I'm at it. And in the near term, data centers, there's endless demand. I don't know how that plays out long term, but
what would cause you to change your outlook materially over the next 12 months? Like what concerns you of in the economy or
okay, so
geopolitical?
I had a piece, and I get asked that question a lot. And as you know, I tend to have everything in the long view. Real estate's not a 6-month investment. It's a 10-year investment. Even if you only plan to hold it 3 years, you're selling to the person who's going to hold it for the other 7, So I tend to look long. If you say what really worries me, and I wrote about this in the last Linneman letter, is education. I think we have a small group of people getting smarter than we've ever had. And we've got a mass of people getting dumber than we've ever had. And it's a whole lot of causes for that. It's a whole topic unto itself. That worries me. Why? Because education is a huge, huge part of how we grow. Back to where we started, that beast. Is our education system perfect? No. It's getting worse, though, instead of better. And and by the way, not just in the worst school in the worst center city, at the best universities in America, some of them are educationally in trouble. Okay, so it's not just isolated. That worries me a lot. If you say beyond that, what worries me, I guess what would worry me, back to where we were, it is very possible we're in an excess of money going to data centers and AI, which is not to say they won't. Remember, I told you autos and housing were classically where it occurred. It's not like the auto that you bought wasn't a perfectly fine auto. It's just you didn't need it for another year. It's not that the house you bought wasn't a perfectly fine house. It'll get used, but you don't need it for another year or two. And that what happens is money that could have been going to, quote, more productive things got sucked into the housing and auto. And I think there is a chance that we're doing all the investing in AI that we should be doing between now and 2030 in the next 2 years. And and what's the cost of that? The cost of that is it could be, it's not that it'll produce nothing. Of course, it's going to produce things. It's that it's needlessly drawing away money from things where it could have been doing more if you'd have spread it over the 4 years. Okay. And that'll drain the economy. And then they'll get to a point where we go, oh, gee, I don't need to do all this. And I wish I hadn't done all this. And people say, yeah, but these are cash flowing companies. Well, they are taking on debt. They're taking on off balance sheet liabilities. And that cash flow could have been used for other things. It's not like it had to be used for this. And I'm not picking on Meta, but just think of Meta. Meta's an advertising company. Yeah. You know, they're an advertising company. They make their money from advertising. Yes, they have a different mechanism of selling advertising and promoting advertising than the madman days of the 50s, but they're just an advertising company. What the hell is an advertising company doing, pouring all their profits into AI? And people will say, well, they know a lot about technology. Okay, great. But why don't they just run a really good advertising company and then give me the profits? And I'll figure out what I want to do with it. So I do think there's some degree of worry, and it won't show up for 2 years or so, that we're doing 4 years of investing in 2 years, and it's draining money from where it should be going, and it will be a source of its own choking at some point.
Guys, I've got plenty of other questions. We're going to go until the top of the hour, but if you have questions, put it in the Q&A, and I'll be happy to ask those questions. What opportunity is kind of hiding in plain sight right now? What are people missing that they should?
Well, this will sound, I think they're overly frightened of multifamily. I think they're overly frightened of multifamily development. Why do I say that? I don't mean a sixplex, but if you take a 300-unit project, that's a 3 years until it comes online, right? Basically. People are looking at today. They say, I'm not going to trend rents. I'm just going to take the rents I see and evaluate from there, because I've gotten burned on the last couple of years when rents haven't gone up for 2 or 3 years. And I'm just going to forecast flat rents for the next 5 or 7 years. Much more likely is that 4 years from now, when your project comes on, 3 years from now, rents are going to be 25% higher. Why? Concessions are going to burn off. You're going to lose 2 months free out of 13 just mechanically there. And then you're going to get rent increases on top of it. And I think you're looking at 20, 25% rent increases 4 years out. Nobody believes that. And the people who believe it, they can convince the debt, but they can't convince the equity. Back to what we were talking about. That's what people are missing. And it's not an absurd scenario, by the way. It's happened many times before. And I think people are missing markets adjust, supply adjusts, rents will grow again. And there, and in an odd way, this is a good time to develop because nobody else is doing it. You'll be one of the few products coming online 4 years from now, 3 years from now, or redevelop in a substantial way, or convert an office building. Because when you come on, it's going to be a very different market than now. And just take any, I'm 75, just take any 4 years later period of time. They're all different. But nobody is going to, no equity source is going to buy into trended rents right now, which means nothing's getting built. And by the way, if you could top that up by saying, and I can find it in a well-located opportunity zone, even better, right? Even better. So I think that's what people are missing. A little less so in industrial because there has been some rent increase. Retail, I don't think they're missing it so dramatic. They missed it in retail 10 years ago and 5 years ago. They missed this same phenomenon in retail. Nothing's getting built. And yes, demand's not growing a lot, but nothing's getting built. That gets a market healthy. I think office, it's true, it's just harder to underwrite the mechanics of office, right? In the following sense, I can be right that multifamily comes back, and I could be right that office comes back, but office is lumpy. It may come back, but not in my building. Multifamily is likely to come back in my building, right? Just it's more granular.
And for the record, everyone, I did not pay him to say multifamily. And coincidentally enough, we bought an existing building, a 300 unit to be exact, about a month ago, at such an incredible basis, just taking advantage of the time. So we don't have to build from new, but we could be in position to take advantage of the marketplace in 2 to 3 years from now.
Yeah. I mean, I really believe I'm not a shill. I'm not smart enough to be a shill.
Yeah. What advice would you give investors who are feeling stuck waiting for clarity? Because there's so much noise out there, and there's a lot of negativity out there. How would an investor kind of figure out what to do best?
Stop watching the shiny objects. Stop watching the shiny objects. And it's been a lesson of my life. Yes, you can't completely ignore the shiny objects like, will the Strait of Hormuz open? That's a particularly shiny object. Will the Democrats take Congress? That's a shiny object. Will Trump try to figure out a way to reinstate tariffs? That's a shiny. I mean, there's no shortage of shiny objects, right? Will the Eagles win the Super Bowl? All right. Well, that's how you ought to think about it. Will the Knicks win the NBA? That's a shiny object. But you shouldn't spend nearly as much time on these shiny objects as you do. Not you, all of us.
Right.
We're instinctively, our defensive evolutionary mechanisms are drawn to looking at shiny objects and fixating on shiny objects. We're in the long-term business. Nobody on this call remembers what happened in 2018 to any of these shiny objects that had people fixated in 2018. If you did a deal in 2018, it's only in its 8th year, and you can't remember what the shiny objects were that had you fixated in 2018. And by the way, same for 2019. None of us remember the shiny object that had us fixated in 2019. If you'd have done an investment in 2019, you're only 7 years into a 10-year hold. Okay. That's a good lesson. Now, obviously, 2020, we all remember the shiny object. So there are times we remember them. GFC, we remember the shiny object. But even GFC, if you look at it, you got overly fixated with the shiny object. The world's going to come to an end. The world didn't come to an end. And it turned out that was a reasonably decent time to invest, even though it was an impossible time to work up the courage to invest, right? So my number one piece of advice, and it only gets more so the older I get, focus long-term, not short-term, and try to not fixate on the shiny objects. By the way, there's a sport equivalent of that. I learned this about 45 years ago. I wasn't throw stuff around the room or break the TV, but it really bothered me when my team lost on Sunday. It really bothered me. And then I realized it's just a game. I can enjoy it. I can want my team to win. I can prefer my team to win. But you know what? After the game's over, I'm fine either way. But at the moment, it's an incredibly all-consuming shiny object. So you can enjoy the shiny object. You can inspect the shiny object, but don't let it drive your behavior.
Well, Peter, I mean, that's a great mic drop for me, for everyone. I appreciate your time and your wisdom. It's always a pleasure to have you on. Thank you so much.
Thank you for having me, and come back when the interest rates fall in 75 bips, right? Have a great day, everybody. Bye-bye.
Thanks, Peter. I hope you got a ton of value from today's episode. If you did, be sure to like, subscribe, and leave a comment to help grow this podcast. I'm Gary Lipsky signing off. I'll see you next time on the Real Estate Investor Podcast. To all of our listeners, thanks for joining us. And if you like this episode, please head over to iTunes or Stitcher and like, subscribe, and leave a review, as it will help us reach more people. And if you'd like to learn more about what we do at Break of Day Capital, head over to our website at breakofdaycapital.com and sign up for our newsletter and fill out our investor application. We'll talk to you next week.